One thing I get asked more than any other question right now is, are mortgage rates finally coming down? And the honest answer is yes, but not in the way most people think. Last week gave us a really interesting snapshot of how sensitive today's housing market still is to interest rates, even tiny changes. Because when mortgage rates briefly dipped below 6%, something big happened. Borrowers moved fast. According to the Mortgage Bank Association, mortgage demand jumped 28.5% in a single week. That's a massive spike, especially for January, which is usually pretty quiet. And this wasn't just one type of buyer. Refinance applications jumped 40% week over week. They're up 128% compared to this time last year. Purchase applications surged 51% in just 1 week, and they're up 13% year over year. That's not theoretical demand. That's people actively filling out applications the moment rates dipped. Why does this matter? Because it tells us something important about where the market is right now. A lot of buyers are still on the sidelines, not because they don't want to buy, but because rates are the gatekeeper. The second borrowing costs ease even slightly, demand shows up immediately. Now, here's the part that caught a lot of people off guard. That brief dip below 6% didn't happen randomly. It came right after a social media post from Donald Trump where he said he told his representatives to buy $200 billion in mortgage bonds with the goal of pushing mortgage rates lower and making homeownership more affordable. The idea is pretty straightforward. When demand for mortgage-backed securities increases, prices go up, yields come down. And when yields fall, mortgage rates tend to follow. Economists agree that in theory, this kind of policy can work. Brad Case, the chief residential economist at Homes.com, explains it this way. Increasing demand for mortgage bonds puts downward pressure on mortgage rates, as long as this policy continues, and that last part is the key. Because this is a big difference between a short-term reaction and a long-term fix. The planned refinance involved government-sponsored mortgage entities like Fannie Mae and Freddie Mac, which buy and bundle mortgages to keep lending flowing. And here's the reality check. That $200 billion sounds like a lot, and it is, but it's not unlimited. Dan Frio, a lender with PBT Bancorp, called this move a temporary reprieve. The last time the government aggressively intervened in mortgage markets, they had over $1 trillion to work with. This time, a fraction of that. So no, this isn't taking us back to 2% or 3% mortgage rates. That era is over, and who knows when we'll see it again. What it does tell us, though, is something just as important. The market is cold. Buyers are watching rates daily. Sellers are adjusting expectations, and the moment affordability improves even slightly, activity follows. We also have to keep this context in mind. Even with recent bump back up, 30-year fixed rates are still around 6.07%, which is meaningfully lower than this time last year when we were hovering closer to 7%. That alone changes the math for a lot of homeowners. So what does this actually mean if you're a buyer? It means waiting for some magical rate drop may not be the best strategy, because when rates move, competition tends to move with it. That brief dip below 6% already proved that. And if you're a seller, it reinforces that pricing still matters so much. When rates dip, buyers re-enter, but when they're still cautious, still payment sensitive, and still value driven. And zooming out even further, this is another reminder that today's housing market isn't frozen, it's rate restricted. Demand hasn't disappeared, it's just waiting for windows like the one we saw last week. Whether those windows become more frequent in 2026 or stay short and unpredictable is the real question. And that's what I'll keep tracking, not just the headlines, but how buyers and sellers actually respond when the numbers change. If you want updates like this as things shift, make sure you subscribe, because in this market, the details matter more than the noise. Thanks for watching. I'll see you in the next one.